Lecture 4. Assets. The main objective of this lecture is to understand the assets component of the balance sheet. An asset is a resource with economic value that an individual, corporation, or country owns or controls, with the expectation that it will provide a future benefit. Assets are reported on a company's balance sheet, and are bought or created, to increase a firm's value or benefit the firm's operations. Assets are probable future economic benefits, obtained or controlled by a particular entity, as a result of past transactions or events. Within the assets segment, accounts are listed from top to bottom in order of their liquidity, that is, the ease with which they can be converted into cash. They are divided into current assets, those which can be converted to cash in 1 year or less, and non-current or long-term assets, which cannot. Current assets plus non-current assets equals total assets. Assets have the following characteristics. They are probable future benefit, that will contribute to future cash flows. They are of a particular entity that will receive the benefit. And the transactions or events, giving rise to the benefit has already occurred. In order of liquidity, assets are classified from most liquid to least liquid, or from current to long-term. Current assets are cash and other assets, that can reasonably be expected to be converted into cash, or consumed within the current operating cycle, or 1 year, whichever is longer. Current assets are important, because they indicate how much cash a company, essentially has access to within the next 12 months outside of third-party sources. It is indicative of how the company funds its ongoing, day-to-day operations, and how liquid a firm is. The ratio of current assets to current liabilities is particularly important in judging liquidity. Current assets typically include categories such as cash, short-term investments, accounts receivables, prepaid expenses, and inventory. Cash assets are assets consisting of cash and items, readily convertible to cash. They are all cash on hand and on deposit, and which are readily available for current use. It is measured in US dollars or any other currency. Prepaid expenses are future expenses, that have been paid in advance. You can think of prepaid expenses as costs, that have been paid, but have not yet been used up, or have not yet expired. The amount of prepaid expenses, that have not yet expired, are reported on a company's balance sheet as an asset. Non-current assets are company long-term investments, where the full value will not be realized within the accounting year. Examples of non-current assets include investments in other companies, intellectual property, e.g. patents and property, plant and equipment. Non-current assets appear on a company's balance sheet. A long-term investment is an account on the asset side of a company's balance sheet, that represents the company's investments, including stocks, bonds, real estate, and cash, that it intends to hold for more than a year. Property, plant, and equipment, is the long-term or non-current asset section of the balance sheet. Included in this classification are land, buildings, machinery, office equipment, vehicles, furniture, and fixtures used in a business. An intangible asset is an asset that is not physical in nature. Goodwill, brand recognition, and intellectual property, such as patents, trademarks, and copyrights, are all intangible assets. Other assets are a grouping of accounts, that are listed as a separate line item, in the assets section of the balance sheet. This line item contains minor assets, that do not naturally fit into any of the main asset categories. Examples of these minor assets are advances to employees, bond issuance cost, deferred tax assets, long-term prepaid expenses. End of lecture 4. Thank you.